Defined benefit plans will involve recording a pension expense in addition to the obligation. So what goes into a pension? What are the elements? Well, there's the employer's obligation. There needs to be funding of the plan assets, and then there'll be recording of the periodic pension expense. So what goes into this expense? Well, there'll be service costs will increase it. Interest costs will increase it. Return on plan assets will decrease it. Amortization of prior service costs increases. Amortization of net loss will increase, and a gain will decrease. And this will be the difference between the actual and expected when the expected is used to calculate pension expense. There will also be amortization of net loss and gain for actuarial gains and losses. And finally, amortization of existing net obligation or net asset. And that's going to be the greater than 10% rule. Okay, now the first three are immediately expensed. The last three are into accumulated other comprehensive income. Will be increases and decreases. So what are service costs? These are increases in employer's obligation from the actual work performed by the employee throughout the year. And it's going to increase the obligation and the expense, and this is expensed immediately. Interest costs, this is time value of money. Be given a discount rate, it's interest expense. This is also expensed immediately in the current accounting period. The return on plan assets, the pension expense can be offset by either the actual return or the expected return. It's a way to lower the pension expense. The return on plan assets will decrease your pension expense in the current period. Now, if the expected return is used, and it's your choice, the difference between the actual and the expected must be recognized in other comprehensive income, not expensed immediately, and then amortized with any actuarial gains or losses. And this is why pension accounting is so complicated. So for prior service cost, these are retroactive changes in benefits. So an example, you were hired in 2001 to a company, but there was no pension. Then 10 years later, the company was doing well, so they decided to offer a pension, and they wanted to make it retroactive to the years prior to the inception of the pension plan, back to the first year that the employee was hired. So this is the difference, looking at a timeline of what is service costs current in the current accounting period and what are prior service costs from before the inception of the plan. Now with the example, let's say 10 years later, the plan is amended to increase the amount of benefits. Company's doing very well and they want to give back to their employees, and they've again made it retroactive to the day the employee began working for the company. So you can see, looking at the timeline, what are current service costs and what are prior service costs. So this is where you hear the component as part of the pension expense into other comprehensive income, those gains or losses. Number 5 that goes into the pension expense, amortization of net loss or gain. So if the projected benefit obligation, not the expense, the obligation, if it's higher than you expected it to be, that represents a loss. If it's lower, that's a gain. And the return on plan assets, it's just the opposite. If it's higher than expected, that's a gain. You earned more on your investments. Or if it's lower than expected, it's a loss. The one above that would be considered a liability. Return on plan assets, that is your asset. So the PBO is your liability, the plan assets are the asset. Now, if the expected return on plan assets is used, the difference between the actual and the expected must be recognized in other comprehensive income, and then it's amortized with any actuarial gain or loss. The 6th component, amortization of net obligation or net asset. So this is where you look at the greater than 10% rule. It must be amortized over the estimated employee service life. So you want to look at the greater of the plan asset or the PBO, the projected benefit obligation. If the PBO is larger, if the liability is larger than the plan assets, the funds you've set aside to fund the pension, then it's recorded as a liability, the net amount. And that's the key. On financial statements, you will not see the total PBO and you will not see the total plan assets. You will just see the net amount. Now, if the liability, the PBO, is less than what you have set aside in your plan assets, then the net amount is recorded as an asset. Now, what about that greater than rule? It must be amortized over the estimated average employee life. So you look at all the employees and you take the average expected service life. Okay, so if you're given all this information, what do you need? You don't need the net gain. You're looking at the PBO and the plan assets. Which one is larger? The PBO. So you look at net AOCI gain, subtract 10%. That's the 10% rule of the PBO. So I'm going to go back the slide and look at what you were looking at. This is the information you were given. First, look at the PBO and the plan assets, the greater than rule. So you're going to disregard the plan assets and use the PBO in this calculation. 10% of that is subtracted from the net accumulated other comprehensive income gain to give you 15. Divide that by the average service life of your employees that your actuary gave you. So your net amortization is 1 of this amount. This is how you calculate this. So again, what goes into the pension plan expense? 6 components: service cost, interest cost, return on plan assets, amortization of prior service costs, amortization of net loss or gain of these 2 different items, and amortization of existing net obligation. This is why pensions, defined benefit plans, are very difficult to manage. The key to remember, the first 3 are immediately expensed. The last 3 must be into other comprehensive income, which is then close to accumulated other comprehensive income. Now, the return on plan assets, actual or expected, the difference between those, when the expected is used, is then amortized. But if you use the actual, you expense it immediately. And that is